Why Powell speaks matter, how Fed rate cut, hints move Singapore stocks and S-REITs. When Jerome Powell clears his throat, global investors hold their breath. A few carefully chosen words from the U.S. Federal Reserve Chair can swing trillions of dollars across continents, rattling Wall Street one moment and lifting Asian markets the next. Just last week, his Jackson Hole speech set off a chain reaction. U.S. stocks surged to record highs, bond yields tumbled, and in Singapore, REITs, long stuck in the doldrums, suddenly sparked to life. For many Singaporeans, it raises a puzzling but urgent question. Why should a speech delivered thousands of miles away in Wyoming matter for our Straits Times Index, STI, and the S-REITs we invest in for steady dividends? Recently, Powell grabbed global attention with a signal-rich speech at the Jackson Hole Symposium on August 22, 2025, indicating the Fed may consider cutting interest rates as early as September due to rising downside risks in the labor market. Financial markets responded swiftly. U.S. indices like the Dow Jones surged nearly 1.9%, the S&P 500, and Nasdaq climbed around 1.5 to 1.9%, and traders priced in over an 85–90% chance of a September rate cut. This dovish pivot from the Fed resonated widely, bringing renewed optimism to global equities, lowering yields, and boosting investor sentiment toward rate-sensitive sectors. In Singapore, stocks and S-REITs felt the impact, triggering catch-up rallies after extended periods of caution. But what's the real connection between U.S. Fed signals and Singapore's markets? Why do investors pay heed to a speech made in Wyoming? In this article, we'll explore how Powell A.S. remarks and broader Fed policy trends shape the trajectory of the STI and Singapore-listed REITs, unpack the mechanisms at play, and outline what Singaporean investors should watch next for both risk and opportunity. Powell's speeches. Why the world listens. The Fed chair doesn't just run U.S. monetary policy. His words often serve as the world's financial weather forecast. Markets scrutinize not only what Powell says, but also how he says it, his tone, choice of words, even what he chooses not to say. At Jackson Hole, Powell highlighted that while inflation risks remain, the Fed is now more worried about weakening employment. That shift matters. For over 2 years, the Fed's main concern was runaway inflation. Now, by openly acknowledging labor market risks, Powell effectively opened the door for rate cuts. The reaction was immediate. Bond yields fell, making borrowing cheaper. Equities rallied, especially rate-sensitive sectors. Fed funds futures priced in a 90% chance of a September cut, up from the 70% just days earlier. So when Singapore investors read Powell's speech today in the headlines, they're not following U.S. news for fun. They're bracing for ripple effects that can flow directly into their portfolios. How U.S. rate cuts spill over to Singapore. Here's where it gets interesting. Singapore's Monetary Authority of Singapore, MAS, doesn't set interest rates the way the Fed does. Instead, it manages the SGD against a basket of currencies. Still, U.S. rate policy sets the tone globally. When the Fed cuts rates, 3 big things happen that matter to Singapore. Global liquidity increases. Lower U.S. rates push investors out of low-yielding U.S. bonds into riskier assets, like Asian equities and REITs. Some of that capital flows into Singapore. The U.S. dollar weakens. A softer USD makes regional currencies, including the SGD, stronger. For Singaporean investors holding USD-exposed REITs, like Manulife US REIT, this currency movement can be a double-edged sword. Better financing conditions, but FX translation risk. Bond yields drop. Global bond yields often move in tandem with U.S. Treasuries. Lower yields make dividend-paying instruments like S-REITs more attractive, since investors start chasing yield elsewhere. That's why after Powell's latest speech, we saw Singapore names like CapitaLand Integrated Commercial Trust, PSU 2.3%, and Mapletree Logistics Trust, PSU 0.6%, rally within days. It AWE's not because something changed overnight in Bugis Junction or Tuas warehouses. It AWE's because Powell hinted that money will soon be cheaper. Why S-REITs shine when the Fed turns. Dovish S-REITs are essentially borrowing machines. To grow, they buy properties using debt. When rates are high, their interest costs balloon, eating into the distributions they can pay investors. But when rates fall, three good things happen at once. Lower borrowing costs. A REIT refinancing a 500 million loan at 4% instead of 6% saves 10 million annually, straight to unit holder distributions. Asset values go up. Valuers use capitalization rates tied to interest rates. Lower cap rates, cheer higher property values. Easier acquisitions with debt cheaper and unit prices recovering. REITs can once again go shopping for properties in Singapore or abroad. History shows this clearly. In past Fed easing cycles, Singapore REITs have delivered double-digit total returns. UOB Asset Management even estimates that a full Fed rate cut cycle could lift Asian REITs by up to 15%, including dividends. For income-seeking Singaporeans, many of whom hold REITs for retirement cash flow, this is the moment they've been waiting for after 2 painful years of distribution cuts and falling unit prices. What about banks and other sectors? Of course, not every sector benefits equally. Banks. Lower rates usually mean thinner net interest margins, NIMs. DBS, OCBC, and UOB enjoyed record profits when rates surged. With cuts ahead, their loan spreads will shrink. That said, loan growth, fee income, and strong capital buffers could cushion the blow. Dividend yields remain attractive, but don't expect the same turbocharged profits. Developers and property stocks. Like REITs, developers benefit from cheaper financing. But local cooling measures and rental demand will still be bigger drivers. Travel and consumer plays. Lower global borrowing costs can boost consumer sentiment and spending, which helps Singapore's retail and travel-related counters. Tech and growth stocks. If liquidity pours back into growth names, some of Singapore's tech-related plays could catch a bid too, though this effect is usually stronger in the U.S. risks Singaporeans should watch. Before we break out the champagne, a few words of caution. The Fed isn't guaranteed to cut. Powell stressed that policy is data-dependent. If inflation flares up again, say, due to tariffs or oil shocks, the Fed may delay or slow cuts. Markets may be pricing in too much optimism. Refinancing timelines. Not all REITs benefit equally. Those refinancing debt in late 2025 or 2026 will lock in lower rates. But if a REIT just refinanced this year at 5%, it won't see immediate relief. Currency risk for U.S.-focused REITs. Manulife US REIT, Prime US REIT, and Keppel Pacific Oak all earn in USD. A weaker USD versus SGD could offset some benefits of lower U.S. rates. Late summer rally. Risk. Some analysts warn that the surge after Powell's speech might be temporary, a seasonal bounce rather than the start of a true bull run. Singapore markets could see pullbacks before stabilizing. Local factors still matter. Mass policy, domestic property demand, and Singapore's own economic growth will ultimately drive STI performance. U.S. rate cuts are a big piece of the puzzle, but not the whole picture. What Singapore investors should do. So what can you do with all this? A few takeaways. Stay invested in quality REITs. The rate cycle is finally turning. Focus on well-managed names like CapitaLand Integrated Commercial Trust, Ascendas, and Mapletree Family REITs, which have strong sponsors and diversified portfolios. Check debt profiles. Look for REITs with high floating rate debt or big refinancing due in 2025-26. They'll benefit first. Don't abandon banks. Entirely, banks may see NIM pressure, but dividends remain strong. Think of them as steady income anchors, not growth rockets. Balance yield and growth use REITs for stable cash flow, but keep some exposure to growth sectors that could rebound as liquidity flows back into equities. Watch the Fed calendar. Key U.S. data, jobs, CPI, Fed meeting statements will drive the next moves. Set alerts if you don't want surprises. Conclusion. Why Powell's words echo in Singapore. Jerome Powell doesn't just move Wall Street, he moves Raffles Place too. When he hints at easing, global capital shifts, borrowing costs fall, and suddenly Singapore REITs and equities breathe easier. For Singaporean investors, the latest Powell speech isn't just U.S. noise, It's potentially the turning point after 2 difficult years of high rates and weak rate performance. The opportunity is clear. If the Fed really begins cutting, Singapore's income-loving investors could finally see relief in their portfolios. But don't forget, Fed policy is never straightforward. Inflation, tariffs, and global shocks could change the script quickly. The smart move? Position for the upside in S-REITs and quality equities, but keep a cautious eye on risks. In the end, Powell's words may be spoken in Wyoming, but their echo can be heard all the way at Marina Bay. For investors here, that echo might just signal the start of brighter days ahead.